Hey, what's up guys? John here. An insurance tsunami is smashing the U.S. housing market.
More and more homeowners are abandoning home insurance because of skyrocketing costs.
The premium for the same level of coverage from Slide was $14,684.
But what the multimillionaires, billionaires, and real estate developers are doing quietly behind the scenes says everything about what happens next. And no, it's not just pay all cash.
The buyers just keep marching into the jaws of destruction. Climate change is going to be factored into how people think about housing. The only people who have figured it out are the actuarialists.
They're doing something very strategic so that they can offset all of these insurance increases. I'm going to show you exactly what that is and what you should be doing right now if you are a home buyer. Maybe you're a homeowner, you think you have equity in your property. Maybe you're thinking about selling that property. Pay very close attention to this. Please hit the like button. When you hit the like button, YouTube's going to share this content to educate other people about what's really going on. And if you'd like to fix your credit to position yourself for the greatest wealth transfer of all time, we'd love to help you at my company, GreatCreditFast.com. That's GreatCreditFast.com. If you have late payments, medical bills, charge-offs, foreclosures, bankruptcies, repossessions, any negative item on your credit report, go to GreatCreditFast.com by clicking the link in the description just below this video to schedule a free strategy session. Take a look at this. So, Florida insurance crisis poses yet another obstacle for home buyers there. This lady was thinking about buying a property. She was quoted $17,000 a year just for the insurance. The current owner, the home seller, paying $5,000. So the difference, $12,000, $1,000 a month in additional costs. Now, if this lady hypothetically is making $150,000 a year, great income, right? $150,000 a year, great income. 8% mortgage rates where they are today. She can comfortably afford a home of $407,000, maybe $420,000. So if you're looking at this price point, anything more than this, she leaves that green area. So it's no longer that comfort zone. So let's look at what this does. Going from a $5,000 per year insurance to a $17,000 policy. So you go from $448 here, so $448, and then you put in $17,000. So she goes from $448 to $346. You lose $100,000 of value getting sucked out of that property. Essentially 25% of the home value is lost just because of insurance going up. But it gets crazier than that, because you think about it like this. When you are a bank or a lender or an insurance company and you're looking at all these headlines, you're seeing everything happen on the world. You saw Hurricane Hillary from Baja Coast, California, up and down the coast in California, and Las Vegas. You saw the situation. You have Fort Lauderdale floods. You had Fort Myers, that disaster that happened last year. You had the Miami building collapse. You had Hurricane Lee. Then you had the situation that happened in Hawaii. You had the fires in Canada. You had the 10,000 missing in Libya due to that wall that broke, that issued a massive flood all throughout Libya. You had all of these problems happen at the same time, not to mention fires in Argentina and all these other problems that have occurred. So this is not just a domestic issue here in America. We're seeing problems happen everywhere. And because of all this, the insurance companies are looking at this saying, you know what, we're going to underwrite risk differently. And because of this, it's changing the whole game for real estate. So he says, I may have to sell up and move. This one here, home insurers cut natural disaster from policies as climate risks grow. Here, as natural disasters get worse, so do home premiums. You start to see this. They're claiming $99 billion in damages in 2022. That number is greatly higher in 2023. Now, here, this is what people need to pay very close attention to. Homes in part of the U.S. are essentially uninsurable due to rising climate risk. Uninsurable. Imagine you're a bank and you were, let's say, lending this nice lady, making $150,000 a year. You're lending her money to buy a property. Well, you'd be lending it based on the insurance premiums. Let's just call it 2018 insurance premiums. Maybe they weren't $5,000. Maybe they were $3,000. Maybe they were $3,000. So based on her income, she could afford a really nice house, right? She could afford a nice house. But when insurance skyrockets year after year after year, you have to ask yourself the big question: at what point can she afford the house? Is it in 2025, 2027, 2028? Well, if so, what happens to the loan? The loan is going to get written off. It's going to be a complete loss to the bank. It's going to be a foreclosure. And so would you lend there? Probably not, right? You probably wouldn't lend there. And so as this is happening, banks are now considering to tighten up. Glenn Kelman, the CEO of Redfin, has been issuing this warning that it's going to get a hell of a lot harder to get loans in many areas. Like, look, people buying homes in Florida's flood-prone coast will likely have trouble selling them in the future. It's Glenn Kelman, CEO of Redfin. So you start to look at this, you're like, okay, well, so what are the wealthy doing, right? What are the wealthy doing? Because they usually somehow time everything, pretty well. This is what they're doing. Climate is driving insurance rates up, forcing developers to add weatherproofing. They're getting ahead of all these problems because they know labor costs for contractors likely will go up and material costs are going to continue to go up. As oil prices rise, the cost to ship, distribute, and transport all the materials to do all of these upgrades are going to get more and more expensive. It's going to get baked into the cost. So they're doing it before the general public is aware. And so here's the extent of how severe this is. So this building here, the Eddy, estimated that flood loss risk from $10 million to $1 million, which meant that their insurance got 10 times cheaper after doing these renovations, right? 10 times cheaper. Then you have another situation here. This person in Miami, they have this property here, Miami Gardens, right here. She recently consulted a trio of a 1970s vintage multifamily building in Miami Gardens, Florida, whose owner, in order to meet new lending requirements, needed to increase the property's wind insurance policy by 850%. Think about this, 850%. From $5 million of coverage to over $47 million in coverage. After the initial risk assessment, insurance firms only felt comfortable covering an additional $5 million. The owner was stuck. How could they refinance if the building's wind coverage was not available? But the building recently had weatherproofing makeover, new roof truss, framings, hurricane ties to the rafters, plywood, sheathing, new windows. What may have once been viewed as extraneous renovations now allowed the client to go back to the insurance companies with a new risk assessment of wind damage, which convinced more insurers to finance the $47 million policy. Beyond finding better insurance deals without weatherproofing features, it has become harder to get insurers to play ball in the first place. Climate resilience then becomes not a nice to have, but an integrated into good risk management and good investment. So you start to pay a very close attention to how this situation is unraveling. It's very shocking. Here's another one. Christine, an executive, USI Insurance Services, said as a result, her clients have seen astronomical premiums. One Florida's office property she advises saw an annual wind insurance quote jump from $30,000 to $44,000 in the matter of 4 weeks. Now you think about this. You're buying an office building, a commercial multifamily property, 5 units and above. What's ultimately happening there? The bank is going to look at, your experience as an operator. They're going to look at the income from the property. They're going to be looking at, the entire picture. But the main thing they're going to look at is the net operating income. How much cash is coming in comparison to expenses? When that cash coming in is reduced by $14,000, that's not, $14,000 off the purchase price. No. That might be $400,000 off the purchase price. And if you have to refinance this property, it's going to get harder to do so. So we're all walking into something very, very big in commercial real estate and real estate as a whole with this insurance crisis that's unraveling here. And they go on here, they talk about all the different risks that are coming and all the markets that are going to be hit. Of course, they talk about the big states, Florida, Texas, California. These states are going to definitely be one that's going to be hit more than many. But look at what Glenn Kelman said. I think this idea that climate is going to be factored into how people think about housing hasn't happened yet. The only people who have figured it out are the actuaries, the people who have to calculate the cost of insuring these properties. So what I'm betting on is over the last, call it 3 years, 2020, 2021, what did people do? Everyone was relocating. They were going from expensive cities into South Florida. They were going into Texas. They were buying these properties with 3-4% mortgages. And many of these people looked at it like free money. They were able to go to a location with 0% income tax, buy this beautiful home, go from being a renter to an owner, and now everything's getting more and more expensive. The job market's softening up. They're not able to refinance their property because they don't have equity. And so what's starting to happen? They're starting to walk into a very, very challenging situation. That's what's starting to happen. And all the wealthy investors are paying very, very close attention. $5.3 trillion in cash is sitting in money market accounts right now. They realize that wages are going to continue to soften and people are going to be forced into a very desperate situation. And when that happens, you're going to see the money rip through the U.S. housing market and acquire as much property as possible. They're going to step in, they're going to do all these upgrades, they're going to start investing in all these properties, and they're going to do so by picking them up for the right price. Everything with real estate, you make the money on the buy. And they're going to do that, I believe, in 2024 and 2025. And we're witnessing the greatest shift in the U.S. housing market that we've ever seen. People look at 2008, 2009 and think that was the great, investing opportunity. No, no, no. The next 2 years will make 2008 look like a so-so opportunity. Watch what's going on here. This is unbelievable. What do you think about this entire situation? Drop below, hit the like button. And if you'd like to fix your credit, we'd love to help you at GreatCreditFast.com. If you have late payments, medical bills, charge-offs, foreclosures, bankruptcies, repossessions, any negative item on your credit report, go to GreatCreditFast.com. Click the link in the description just below this video to schedule a free strategy session.